Hello everyone, and welcome to the Sleep Well Portfolio and Awake monthly meeting for June 5th of 2023. All right, we've got lots to cover today. We've got some macros, some regular stuff, but before we get into all of that, we got to go through our disclosure, so let me just kind of knock that out right away. All right, so Environmental Trading Edge LLC, Aramir, if you're watching this from Aramir, are not broker dealers, financial advisors, investment advisors. All past performance is not indicative of future returns, and options, if you're doing options and things like that, are not suitable for all investors. Please talk to a financial advisor. Yep. If you're watching this recording, go ahead and stop and you can read any of this as well, or go talk to a financial advisor. All right, now that we have the formalities out of the way, let's talk about what we normally go through in this. By the way, everything is tuned in pretty much to YouTube now, so if you guys are here live at YouTube, you can basically just type in whatever you need to type in the comments, and I will come and grab it as I come back and check on YouTube. Alrighty then. So if this is your first time watching this monthly meeting, we basically go through the current allocations and what's kind of going on in the Sleep Well portfolio and the Awake, and then we look at kind of the performance to date, and then we'll dig in a little bit deeper and we'll go into the performance and analysis of each individual asset. Then we'll go through the macro analysis as far as what's going on in the macroeconomic side of things. We'll talk about the bear market / recession that we are pretty much going into right now. And then we'll talk about kind of those things. And then I got sent a few questions that I'm going to hit up along the way, so I shouldn't need to necessarily dive into one of those individually. And then one got sent to me about the 10-year, so we'll talk independently about the 10-year and as far as its yield is concerned. Alrighty then, so the Sleep Well portfolio is set up pretty much a lot of SPY. Now, what you're going to hear is you're going to hear some things in the macro side of things that is going to be a little bit more bearish on side of things. But of course, bear markets and recessions, the market kind of decides when they start. So we know the general time frame about when they're going to start, which is about now. And then as far as when they actually keel over, when they actually start kicking up, sometimes they're a little bit early, sometimes they're a little bit late. This one had a lot of momentum going into the end of this last quarter, so that takes a little while to fizzle out. So as it's fizzling out, we still have a very large amount of allocation into the SPY for the Sleep Well portfolio. But here soon, we will kick back into most likely, and I'm just, I'm kind of projecting out in the future, not saying that I'm necessarily going to always be right here, but we should get back into UUP here pretty closely, or here soon. And then the two assets that will show up predominantly over the next month, I would probably say will be gold will be number one, and then TLT will probably be our third one. So we are going into the deflationary part of a inflationary recession cycle. We won't get into necessarily full deflation, but we will get there. All right, inflation will at least pull down, and I'll talk to you more about that as far as how the models are showing, and then what other people are also looking at as well. You can see here pretty much 1 year price change is up for the S&P. So are we. We're pretty much well, we'll talk about that in just a little, but we're keeping up most of the way with it. TLT is basically getting still hammered. You can see that it's just kind of flattening line here. And then gold has actually been having a nice little run, but it's lately has been pulling down pretty significantly, right, from its highs. And you can kind of see that across the board. Small caps, emerging markets, they've had recoveries from the lows, but they have not been strong. Pretty much everything has gone into the S&P and in the NASDAQ. So basically very, very tech-heavy rally from the bottoms into October-ish of last year. Alrighty then, I added one thing. If you're over at the environmental trading edge side of things, I added one thing onto the Sleep Well portfolio, which is just these leverage high watermarks, just so that you see them. I don't have a tracker yet built in to say, okay, where are you as far as the leverage under high water. I know the Environmental Trading Edge website is not as necessarily involved as the Aramir website, where the sleep well portfolio was first initial offered. The Environmental Trading Edge side of things is significantly more geared towards the options side of things. So, but I will get these little things, filled in here and there, and start changing some things soon. I've got some help with building a little bit more onto the website and doing some other things. So, but it'll take me a little bit of time. All right, on to other things. Let me talk about performance. Let me make sure none of you guys have said anything. Nope. All right. So as far as the sleep well portfolio versus risk parity, that is our general portfolio that I said we would basically make sure that we always outperform. We definitely have been doing that with flying colors. We are over here. We had a nice little solid month. We have been climbing this whole time very nicely, and we are pushing up. I actually realized just now that I did not update that number. We are actually over 30, but anyways, we have been climbing really nice and steadily since we have transitioned out of the pretty solidly bear market. So we put in our bottom, technically we put in our bottom back here, pretty close to where the stock market did. The stock market actually put it back here, and it is what it is. So we did it in a very different way. We did it through gold, actually, was what our initial rally was, and then transitioned out of that. But we are climbing, and we are outperforming 60-40, and we are outperforming risk parity pretty solidly. In fact, risk parity is actually, since we started this service, risk parity is down 13%. It's really sad, actually, what's happened to that portfolio. At one point in time, it was like the piece lower is the smallest. Like that was the perfect portfolio. But anyways, depending on how you've allocated that portfolio to, you might be okay, you might be better off. I know our par is the actual ETF that we follow, and there's a little bit of drag on that, so it might not be as much down. But anyways, you can tell they pretty much had a flat month here. We were up, so we have been basically doing our job by keeping that solid. And on top of that, it's pretty easy to manage this thing, so it's been nice. It's been nice. We will, as we go into this more traditional side of a recession, the assets will behave significantly different than how they behaved through this portion of the recession, right? So this portion of the recession, yes, we stayed afloat, right? We didn't, you've got the S&P down here that drew down really aggressively, and we stayed afloat back here. And then we had a little drawdown in the transition as it flipped, right, which happens. But we stayed relatively afloat and kept our drawdowns down to under what we statistically make our drawdowns at. But that was because we really didn't have a strong asset to move into for that time frame. So if you look back at that time frame, gold was rolling over basically everything. Everything was getting nuked except commodities. I realize that I do not have commodities in this portfolio. It's because it's very rare that we have a situation like what we had, but they do happen. So anyways, that was our basically, we were going to hold steady, be steady Eddie through that. And then we was hoping that we would, when we hit new highs last year, that we would actually continue to climb. But we ended up getting a transition because the Fed ended up reversing and slowing down a little bit early. So it was kind of interesting what they did, but I digress. Now, what we look like going forward is most likely what we'll do is we'll be able to push into gold and bonds like we traditionally have during deflationary or deflationary pressured recessions. And that is looking like that's going to be the case. Bonds aren't going to be as strong as they used to be. So if you look back at our performance in 2008, which I'll show a little bit later, we were able to do very, very well. And even in 2011, when we had the debt crisis, very well. And that's because we leverage bonds, right? And bonds are pretty incredible as far as when their yields start dropping, that they can be really powerful. This time around, they're not going to be as strong because the Fed's not going to be able to drop as far because inflation's not actually going to go into deflation. So we'll talk a little bit more about that later. But more good times to come. We will transition out of this S&P typically on the rollover, right? When the S&P starts to increase its volatility, we'll probably get a little bit of a sting, and then we'll transition into our allocation that we need to. So, all right, the awake here is at a 1x leverage. We've been at a 1x leverage for a couple weeks now, and we are 100% in SPY, so we're pretty similar to the Sleep Well portfolio right now. Now the awake is up about 17% for the year, so it's significantly different than the other one, but that's because this one will definitely always meet or beat the S&P 500. So it is doing its job very well, but I will say being 100% SPY, it'll do this until basically we get our signals that we're going to roll over, and then we'll flip out of this and move on to some other things. Sometimes it happens all in 1 week, so like I wouldn't be surprised to go from 100% SPY to next week being 100% all cash, right? The awake will do that. It's significantly faster than the S&P or than the Sleep Well portfolio, so know that that can come. Let me check in on you guys really quick on my other screen. Nope, I think we're doing good. Yep. Alrighty then. Moving on. So as far as just looking at how things have come to date in the awake, like I said, has had a much stronger year here. But we are basically back up to above, we're basically break even since we started. So going through the entire recession, going through the turn, going through everything, we are now at basically making money again from where we started, which is different than the S&P 500. The S&P 500, which where's my marker? The S&P 500 is still down almost 6% from its highs. Now we did deleverage, so that means that our returns aren't going to be typically as strong from here until we start to take a little bit of a hit. So the way that that leveraging works is that the stronger and longer our returns are stronger, the more we deleverage. The worse we get, the more we leverage up. So vice versa. So we ended up leveraging up, I think, somewhere around here, which was kind of poor timing of words. It would have been great if we would have leveraged up right here, but you know that's the name of the game sometimes. Anyway, so we took a little bit of a hit right there as we were leveraged up, and then now we've basically been leveraged through this whole thing, and we just deleveraged right here. So now that we're deleveraged, anything that we see in here is going to be a lot more like docile, right? We're not going to see these big, huge swings like we've been used to. For the leverage cycles, so not nearly as aggressive versus what this portfolio can do. Even in our drawdowns, we did not exceed our max drawdowns, so statistically we're pretty much right on point. Everything's working how it's always done historically. The only thing that we're looking for now is to have a nice finishing solid return for the year. Our average return is 56. Our low end has definitely been 0. We've had that before. And then our high end is in the triple digits. So if we do end up getting this recession like we think, we should be able to get some really nice returns out of some of those other leveraged products such as bonds and gold. And we might be able to pull into at least the high double digits, but we'll see where we go. All right, so let's dig into the individual assets from here. So individual assets wise, it's pretty clear if we just step back and look at all of our assets that we play with here, who's the winner, right? That is the S&P at 16.85 is like where I grabbed this. So the awake is pretty much just north of here, if you were to kind of imagine that, where that is. So it's doing really nice and strong. The Sleep Well portfolio is somewhere around, I think, 12 or something like that. So it's a little bit lower. It might be a little bit less than that. But anyways, it's doing, no, I don't think it's 12. Yeah, I'll see it it's on the next screen. But anyways, it's pretty much mediocre right up here. The only thing is that pretty much all of our assets, all of our assets that we actually work with are significantly underperforming that, right? So you've got 7 on the small caps, you've got 4 on gold. It had a great stellar beginning part of the year, right? Gold was amazing, and then it just nuked. So it just really kind of has fizzled out. That is not going to be the case over the next 6 months. Gold will actually probably be the best asset to have over the next 6 months as real rates start to basically get nuked. So that's going to be a really good asset. that will be our primary asset over the next 6 months. I promise you, probably 6 months from now, we're all going to be talking. We're going to be, knee deep into the recession, and we're going to be all talking about how gold's been amazing, right? And then emerging markets and the dollar have basically gone nowhere, and then bonds have still been basically being hammered. We will talk more about the 10-year and the 20-year a little bit later, because I've got a question that talked about that, and we'll just kind of talk about that a little bit. I seem to have misplaced my water, so. Okay, so individually looking at the S&P 500, we have had basically a leveraging up situation. So a lot of irrational exuberance coming in here. I mean, this thing, the bullishness at the peaks here are just insane. We haven't seen this much bullishness and just general broad market bullishness from Joe Schmo investor. It's pretty amazing. I was talking to a buddy of mine, very smart individual, very up to date on economics and things like that, and it's amazing that I was talking to him about how we were basically going to be contracting again, and it is really incredible how like short term our memory can be sometimes too, because my buddy and I had the same conversation in 2020, or not 2020, 2021, right before 2022. And we were talking about, hey, there's going to be a couple contracting quarters here. It's going to be pretty nasty on the first quarter. And so I was asking him what he was doing, and he was like, no, no, no. And this was basically when that crazy bullishness was in December also, right? Everyone was like, yeah. And then, of course, January happened, and then we all know the story from there. So it's kind of interesting how things like that, when the same model that predicted and was set up for that situation is also saying it now. And but my friend was literally like, no, this time's different, right? We're not going to get this. We've got this acceleration, we've got this, and we can really it's amazing how much the rational brain can come up with reasons to believe in the crazy amounts of bullishness that's out there, and especially when there's a mass movement of everyone thinking the same thing, that you're like, oh, I'm the odd one out, and it's really weird being like that. So anyways, just to and he was basically like, well, we've been talking about recession for years now and it hasn't happened, and that's just how it starts. I mean, if anyone remembers, back in 2006 and 2007, we all knew the housing market was going to be a problem, right? And then it was like, oh, well, it's not getting into the rest of the finances. Oh, it's not becoming a problem. Well, it's not metastasizing or anything like that. Everything's fine. And then eventually it does. And it happens. And then you end up getting the actual recession. So anyways, kind of interesting how it all happens. Anyways, the commercial real estate is going to be a problem. The housing market is going to be a problem. There's going to be some things that's going to be a problem. So it is what it is. Like, we're going to have to deal with it. But anyone that's kind of in denial about it is okay. Like, that's fine. The data is going to point to something different. So I just want to speak here about this chart. This is a very growth sensitive asset. The S&P 500 and not emerging markets. But the S&P 500 and the small caps, the U.S. small caps, are very, very growth sensitive assets. Growth sensitive assets need accelerating growth. The reason why the S&P is doing so well is because there is accelerating growth on the AI space, but that's in this microcosm inside of the fact that we re-accelerated in growth over the last 3 quarters, right? So now we're going to go to the other side. We're going to start to accelerate to the downside over the next 3 quarters. So what is AI going to do then, right? So you're going to get some, lift from some advancements in technology, kind of like what we had in maybe in the 90s and stuff like that. But still, no matter what, the whole tide is going to go out, right? And so, what do you do? The first little pop in 2020 wasn't that bad. And, I say that it's still 27 and 30% down for a lot of broad-based indices, and a lot of companies went 50% down. So even Amazon was actually down pretty aggressive. So you try to think about that, and the next downturn is actually going to be bigger. We'll talk about that in just a second. Anyways, so these are very, very likely the tops that we're looking at in the S&P 500 before we roll over. This is basically the same set up as what was happening in December of 2021 before we went into that economic slowdown as well. So just know that I'm basically saying the same thing, and we'll see how it plays out. Okay, so I left the S&P, or I left the SPY back there just for reference sake. But here is bonds. This is one of our first assets that we look at. Bonds have really not been going anywhere, as I've said, quite aggressively. As inflation remains high, bonds are more of a problem than an asset that you want, right? They have yield now, right? And remember, the TLT follows the yield of the 20 of the 20-year bond, right? And you get some dividends from it too, right? But all I'm saying here is that that asset is not our friend in high inflation. It will be our friend in high inflation that's dropping inflation, and if there's enough demand for US bonds. We'll talk about that again later. So anyways, we'll see where this backside goes. As this deflation kicks in and we start to calm down in the back half of 2023, this will be a really great asset. I'm not saying it's going to go all the way to the moon or anything like that, but I would definitely anticipate this to definitely roll up here, and we'll probably come back up into this range pre-2021 levels, and I think we'll be okay up there. So we'll see how that all ends up flying. All right. As far as gold, which is G on this terms, let me make sure I'm not missing anything over here. We're doing good. All right. As far as gold is concerned, we have been climbing really nicely since the transition from the high inflation as it's rolled over, and that's been fine, as real yields have been has actually been positive. Now, the one thing is that as the yield curve continues to inflate, as the inflation starts to cool off in the background, our real yields become more and more positive. That's a bad thing for gold. So what we'd want to see, what's really good for gold, which is about to start happening, is we get inflation dropping down, right? Or stabilizing. We'd even be okay if it reaccelerated, but then we get yields dropping aggressively. So then we start to get those negative real yields, or we start to get dropping real yields. As we get more dropping real yields, we end up getting a really, really nice kick to everything else. Let me turn off something really quick. Just a second, guys. Okay, sorry about that. All right, I'm back. Now, what ended up happening, what's going to happen well with gold is, as that real inflation starts to compress on the backside, as we get into this recession, it'll become really nice and it'll be a good asset. And then when we get a reacceleration of inflation, it actually should be even better there for a little while, until the yield curve starts to kick back up from the Fed starting to raise rates again. So gold should be a really, 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 really fantastic, fantastic asset over the next year. I'm really looking forward to the returns that we're going to get out of gold. All right, now UUP. UUP is back here. It's our dollar, right? Typically early on in a recession, like what we're about to get, we will end up getting a strengthening UUP. So we should see this guy climb up here a little bit stronger and longer as the S&P rolls over. That's why I said we'll most likely get reinvested back into that, because it is our favorite asset when the S&P starts to become an issue early on in a recession. Inevitably, we'll drop out of it, but in the beginning, it's a strong one. Now, here's small caps. Small caps are already struggling. You can see the amount of struggle that the small caps have versus the S&P 500. Why is that? Well, there's a commercial real estate problem happening, right? A really big commercial real estate problem happening. It is arguably bigger than 2008, but it's not in the single family home mortgage-backed security space. It's in the commercial real estate problem. So we will see if we somehow get this under control, but the size of this is pretty massive. So we'll see what ends up going about this. Now, there might not be as much like fraud and garbage and stuff like that like there was in 2008, so hopefully it's not as bad. But you know, it's pretty nasty back there. So as these, now there's an accounting change that happened back in 2008. Basically, you don't have to show your assets at face value or account for them until you actually have to sell them. So until some of these things have been sold, they don't actually look like losses on a lot of these books. Once they actually show those losses, that's when things will start to be really marked down. So we'll see when that ends up starting to happen. Typically, you need some sort of volatility event or a liquidity crunch where banks start to need that liquidity. Or you get something like what happened at Silicon Valley Bank, where you get a rush on the exits and someone goes and pulls a lot of money, and these banks need to start selling those assets. And then all of a sudden they're a problem. Now, what the Fed did to solve this problem, because they know it's an issue as well, what the Fed did to solve this problem was they created a new it's like a new repo facility, basically. What it is, hey, if you've got bad assets, right? So say, some sort of commercial, real estate security or something like that. You've got this bad asset and you need liquidity to provide your customers with cash, and you don't want to sell that asset for its face value right now out here because it's trash, then the Fed will buy it from the bank for a low interest rate, right? So you're going to pay for selling it to the Fed, but they'll buy it at whatever you purchased it at. So that's going to be really, really helpful as things kind of blow up. So that might actually stop them from fully blowing up. So that's kind of a good thing, because what happened in 2008 is everyone basically started to sell those assets, those mortgage-backed securities, all that kind of stuff. And like I said, it's not necessarily in the mortgage-backed security space. It's more in the commercial real estate this time. Everyone started to sell it, and when everyone's starting to sell on one side, it just crashes, right? All the values of everything crashes, and as it crashes more, you need to sell more of them to get the liquidity you need. Therefore, you need to sell more, and it just becomes this vicious cycle. So the fact that the Fed basically said, hey, guess what? We'll basically bankroll you at whatever value you purchased them at, keeps them from the open market. And so you can't necessarily have a waterfall sell-off in commercial real estate. So that's a positive thing. Now, it's not necessarily fair, but whatever. It stabilizes the financial system, and that's what their job is. All right. I know that was a little complex, so let me kind of cruise through this a little bit more. Emerging markets, basically, they've got some growth over there, but we've got some strengthening dollar all year. So if you see UP has basically been strengthening back here, and that will hold EEM a little bit down. We would like a weakening US dollar with strong global growth, and we do not have that yet. But it has been positive. Like we said, it was going to be a positive asset, just not as strong as the S&P, honestly. So there you go. All right. Overall, month to dates, the S&P 500 clocks us in at a nice 3.59. UUP is pretty much flat. TLT is taking on losses. Gold's taking on losses. Anything with fixed is basically still taking on losses. IWM's up a little bit. EEM is And then we basically clock in here at a 2.74 for the month for the Sleep Well portfolio and a 3.42 for Awake. So good month. It's been solid. All right. Now, of course, the question that I always, ask and look at, I go, okay, how are the assets moving? How are the models projecting? What are we looking like we're going into? What's a similar time so that I could sit there and say, hey, what are we, most likely going to react like through this? So we've had a very challenging macro environment for quite a while now, as we went into something that basically hasn't happened for 40 years. Good thing is that the models took care of what they needed to take care of and adapt to where we didn't basically get beaten down like what happened in bonds and RPAR and 60/40s and all that kind of stuff. So we did a really good job at staying up. Now we just like to make some more money, right? Well, where are we at? The place that I look at right now, as far as like where we're going, and I want to preface that I do not believe this is about to happen, right? But I'm just looking at a time frame in which the assets are moving very similarly to what it was like, and it was actually right here pre-COVID. This is exactly how everything kind of plays out right before like a COVID type of event. Also, right here in 2018, right? 2018 was roughly a 20% drawdown, but that was only a single quarter of contracting GDP. COVID was a single quarter of contracting GDP. 2022 was 2 quarters of contracting GDP. So you can kind of see what I'm already talking about here, right? Single quarter, 2 quarters. My projections are that we're going to get 3 quarters. So if that plays out, if we get 3 quarters, I'm not saying they're going to be a death sentence. By the way, we got a year's worth of contracting in 2008. It might be 3 quarters. But what ended up happening, because I think they overlapped. So anyways, we'll just call it 3 quarters. We got 3 quarters of 2008, but those were really deep contracting GDP quarters. We shouldn't have that deep of an economic recession. I hope, at least. So it shouldn't be nearly as bad as 2008. Will we roll over? Will we, maybe tag the COVID lows or something? Yeah, that's all possible. But as far as the S&P 500 is concerned, but that's how our assets are mimicking, is basically exactly like anytime we get a contraction, right? We're pushed into the S&P 500. You can see right basically before it rolled over into COVID, we were basically 100%, almost a full 100% into the S&P. And then basically I started to see that we were going to get pushed into gold pretty aggressively, which I'm telling you now, we're probably going to get pushed into gold pretty aggressively. And then the dollar, which again is basically the next thing coming up. And then eventually bonds start kicking in. This also happened right before basically the big meltdown in 2008. Lots of S&P over here, right? Eventually you get into dollar and gold, and then eventually bonds kick in. So, I mean, it's literally almost the same playbook. It's almost exactly how all the models are kind of projecting and pointing for the next couple quarters. Now, remember, just because they're projecting this way doesn't mean that they're actually going to follow through that way, and it doesn't mean that it's going to happen right away. That's sometimes what happens to us, like what happened to us in late 2022 up here. Let me find my pen. So late 2022 up here, we basically started pushing into defensive positions, right? We started to get bonds, gold, dollar very aggressively, all while the S&P rocket shipped for 3 months, right? Where it was kind of BS, the fact that it rocket shipped for 3 months, but it is what it is. Eventually it kind of fizzled out and, gave back all those returns, which is pretty much what happens. So anyways, we were a little bit early in 2021. We might be early this time as well. I think that we're not. I think it's playing out that we should start rolling over pretty much now, but we'll have to let the assets and we'll let the market decide, right? I don't decide when the market rolls over. The market decides when it wants to roll over. When is up to it. If is up to the models. It will do it. It's just when is the question now. All right. Let me check on you guys and make sure I'm not missing anything. Oh, perfect. We're doing great. All right. I also have a little bit of a time crunch today, guys, just to let you know, because we have our weekly Q&A because of the holiday. We have the weekly live Q&A on YouTube as well. So if you guys are a subscriber to the YouTube channel or anything like that, at the Environmental Trading Edge YouTube channel. You guys can join me over there once we're done, and I can probably answer any questions if you've got anything over there. All right, now we're going to cruise through the macro stuff, guys. Man, I really wish I had my water. Hold on. Give me. Okay, I'm back, guys. All right. I feel a little bit better now that I got some water. Okay, now we are moving into the macros. So where are we at in the yield curve? Still horrible, right? Very, very, very inverted. I shouldn't say horrible because it's honestly a good thing. Short-term yields are going to, brick here very soon, and it's going to be really amazing. So if there's a spread between the short-term and long-term yields, like if someone was taking advantage of that, big, big wink, 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 right? That is going to be a really, great play over the next 6 months. Oh my God. So this thing will uninvert and become amazing. It always does this going into an economic slowdown, a recession, all that jazz. Look at this. It uninverts, it uninverts, it uninverts, it uninverts, it uninverts. Why is that? Recession, 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 right? It's just how it is. We're projecting recession. So what is this guy going to do? It's going to go, and it's going to uninvert. Now, will it get down to as low as it was back here? No, not unless the Fed does something really nutty. But will it uninvert and come all the way down to maybe, its reasonable lows down here? Absolutely. Yeah, that's a normal yield curve. So we're looking forward to that. That's going to be really amazing. Of course, that is not part of this portfolio, but I'm just letting you know, wink, wink, it's a really nice spread right there on the closer term and the further out terms. Okay, speaking of the closer terms and further out terms, we are basically at this inverted yield curve. So here's our front end, right? Here's our 3 month, right? And then our longer term out here is, you can see here, just here recently is kind of lifting up just a little bit, just as we've gotten this kind of excitement over the last few, or over this last quarter or so. Doesn't mean it's going to stay there for a long period of time, but they are getting a little bit of lift on the backside of the curve. We'll talk about that a little bit more. But basically, it's possible that can be going down to the fact that there might not be enough demand for the amount of U.S. debt being pumped into the world. So we'll talk about that. All right. That's pretty much no new change here, right? We paused interest rates. We've stalled. It's been a month. We haven't had anything new. They're saying that they're going to raise it again. That'd be really sad and stupid if they do. I say that I'm not smarter than them. They've got some other agenda on the plate, possibly, or something like that. But what's going to end up happening is if or when they do raise interest rates again on the next meeting, it should invert the yield curve a little bit more. But that will really, really, like I said, it'll invert it more because it'll really sink down the backside. Because the higher you push the short-term interest rates, the harder it is on the economy. The economy is already going to go into a slowdown on the next 3 quarters, aka, yeah, blow up. All right. So if we look at the odds of recession per the New York Fed, they basically say, how inverted is the yield curve, and they put some sort of recession thing in it, right, about how the odds are. So you can see back here, basically when we get 1970s and the late 1970s, right, or middle 1970s and even the 80s, how inverted the yield curve is. Basically shows how much of a recession there's going to be, right? So here you go, inversion, inversion, inversion. Here's 2020, right, before COVID. It's not necessarily saying that there's going to be a recession. It's saying that when we get this kind of a setup, that it makes the the financial markets and the economy a little bit more top heavy or sensitive to something like a contractionary event, and it typically creates a recession, right? It just needs a catalyst. So right now we haven't had a catalyst, right? And since we haven't had a catalyst yet, we really haven't been rolled over and blown up or anything like that. In fact, the massive tightening and everything and the rolling over and all that stuff that we had at the beginning of last year and the crypto pop was kind of the first thing. Now we get a little bit of rebound from that, um, kind of like if you want to call it like a dead cat bounce, as you guys kind of know what that's saying. And then now we're going to end up getting the actual follow through on the backside of things, economically speaking. Remember, economics take a lot longer than, like, say, some sort of technical indicator like a dead cat bounce, but it's basically the same effect. You still got momentum. And then you've got a rebound effect, and then you still have to finish off the actual drop. All right, so as we talked about inflationary cycles, how these kind of ebb and flow, we're going to go into more of a deflationary cycle because we already pushed past the inflationary cycle. So now we're going to be pushing later into the deflationary recession. So basically we got a inflationary recession in 2022, and now we're going to get a deflationary recession in 2023. So this deflationary recession in 2023 looks a lot different than inflationary. Inflationary recessions, the market actually stays up a little bit stronger, and deflationary recessions actually are a little bit more longer lasting, and they also hurt a little bit more as far as the S&P 500 and growth assets, right? So a few recent ones that we can definitely all talk about, like 2008 and .com. Basically what happens is you get the Federal Reserve raising interest rates too long, too far, and then eventually the inflation, yes, this is a year over year metric, but basically the inflation starts to predict out that you're going to get a deflationary cycle. So as you can see here, the inflation back here in orange is already going low, and then we should kind of steady out back here. And that'll be more like, I'm thinking that we're going to get more like a .com type of recession. So I don't think it's going to be as severe as '08. But basically more like a .com, right? Now, granted, .com was like 2 years long, so I'm not thinking it's going to be that long either. But it will take a little while for things to kind of work out of the system, depending on like what blows up, what pops, what the Fed does, what the government does to kind of stimulate things here in the United States, and then what other countries do as well, right? Because the U.S. doesn't quite have the like the ammunition that they did going into COVID or in 2008, where they could kind of print their way out of a problem. Since we don't have that type of a ammunition, we're going to have to be kind of creative about how we deal with things. So I think that's why the Fed's doing those, kind of standalone repo facilities and those types of things to kind of help with the financial markets on the backside of things, because they know they're not just going to be able to just drop interest rates and print money. The U.S. government might pass some laws and stuff like that during recessions to try to spur up stuff, because we're definitely going to be going into an election year also. So yeah, you never know. If you can borrow and print some money to help some things out, typically that's what you do, right? You care about the people and you don't want people to suffer. And if you're in a position of power that you can, ease on some of that suffering, in the short term, you do it, even though in the long term it might be a problem. So that's kind of that short-sightedness that we have sometimes, but that's just part of us being human. All right. Anyways, I digress. Now, this deflationary recession will most likely act where you'll see the federal funds rate, it's holding steady right now, but eventually they're going to be kind of like what happened in COVID, right? They're going to eventually drop this guy down, but projections show that they're probably not going to be going much more than 3.5. Now that is still a relatively big drop, right? I mean, we went from 2.5 to 0 in COVID, right? So if we go from a 5 down to a 3.5, that's still about the same amount of interest rate drop. So that is stimulative, right? That's very solidly stimulative. but they're not going to go down much lower than that. It's like they're not going to kick it all the way back down to zero, and they're definitely most likely not going to be able to do anything like what they did in '08, where they went from a 5.5 all the way down to zero. That's most likely not going to happen. So the type of performance for like that upswing that we got out of bonds in that time frame is likely not going to be there. But what it does do is it makes gold more attractive, right? So when bonds can't do it, gold will take care of it. So just a little, sprinkle of goodness right there. All right. Now, here is our PE ratios. We are still climbing up, and we have actually gotten to a point where we're kind of, in my opinion, starting to get a little overvalued again, especially since we're going into a recession. Here's our Buffett indicator, almost at 2 standard deviations again. Oh my God, people are just crazy trying to buy up everything they can find. It's going to be pretty sad because it's all going to melt down, but it is what it is. All right. Now, here is our macro. Let me see here. Let me just make sure I don't have a question or anything. No, we're doing good. All right. Just make sure. I heard like kind of a rumbling, so I wasn't quite sure if we were about to have an earthquake. Nope, we're good. Anyways, live watch me have an earthquake or something like that, right? Anyways, I digress. So the sleep, our forecast is basically setting up that we're going to get all the way down to about a 3.2 on the low end for our inflation. We might even go a little bit lower than that if that recession really kicks in strong. We might actually get down to like a 2.5 or something. That would be freaking incredible as far as like inflation is concerned. But of course, that means that less people are buying. That means that less people are willing to pay good prices, which means that typically unemployment is going to go up and things like that. So there is some bad things to that, even though if we look in like, just down through a pigeonhole, that this is going to get a lot better. It is what it is. All right, core inflation is still rolling over, but we don't have any new data on that, so it really hasn't changed. We don't have any new data on this, right? That's basically going to show that the dollar is going to continue doing basically what it's been doing and slightly rise, but not a lot of action on the dollar as well. The general GDP estimates for the second quarter is basically that it's going to be nice and positive. With the second quarter is already over, so it really doesn't matter anymore. The stock market doesn't care about it. It is what it is. It's back in the rearview mirror now. Now, our next quarter is going to be a little bit of a different situation. I'm forecasting right now we're sitting at a 1.3 negative. So we'll see if we end up pulling that off, and then I'll show up actually what some other people are forecasting for their GDP forecasts. It's kind of hard to believe. Like I will admit, like I was talking about my friend earlier, saying, well, yeah, but everything's so great right now. It hits me too, right? Like I sit there and I go, man, really? Like my models are sitting here showing like negative that? What? I mean, like, is that really going to happen? I remember the same thing in 2021. I was saying it and I was like, I almost didn't believe it myself because, everything was just going up and it was so strong, and, the consumer was strong and all of this. And there's all these reasons that it shouldn't be a problem. But it just is what it is. The models say what the models are going to say, and they're data dependent. And I'm kind of like a feeling based person because I'm human. So anyways, I digress. The models are what they are. We'll see what they end up showing. Okay. Now we end up. So I wanted to show this up here. This is basically initial jobless claims. This is something that you can start looking at basically leading up into a recession. So I was trying to say that we do have something brewing in the background. Remember, I've been relatively bullish over the last. The S. Look how much stocks we've had in the portfolios over the last few quarters. Right, we've been bullish, but this is all changing. Right, we are now going to go into this other side of things where we're going to basically get a recession. And the reason why we can kind of see that is typically initial jobless claims creep up right before a recession starts to hit, right? So you get this initial jobless claims going positive, initial jobless claims going positive, initial jobless claims going positive, initial jobless claims going positive. It's just how it is. Even the not recession in like 1990, 4.95. That one still, it was still a contraction in the economy. It just didn't turn into like full blown recession. The only one that's kind of an odd one here is this like 1982 one. I don't know. That was kind of weird. Now, granted, inflation or yields were really high. So what does it look like right now, right? Well, here we go. Initial jobless claims on a rate of change basis is creeping up, and we are now into positive territory. This is where we start to go, oh, there might be some problems. This is very different than just like pure unemployment, right? When we start looking at pure unemployment, unemployment is people that just literally are not working. Initial jobless claims are people that are like getting laid off right now, right? And they're like, hey, I need to go claim some unemployment, right? And they claim. So initial claims like are more people filing for unemployment. And as more people file for unemployment, you can see that when this number is negative, right, everywhere back here, it's actually a good thing, right? Less people are filing for unemployment and it's actually going down. But as soon as this starts over into positive, as soon as we get over this black line here, that means that initial jobless claims are actually starting to go up. And that is where we start to get some red flags. That's where we start to see, okay, we've got some problems. When it first cuts over, it's not normally an issue. Also, just to let you know, typically 6 to 12 months after this goes positive is typically when we see the recession. 6 to 12 months, so keep in mind. We started to see this go positive. I mean, we could argue that it kind of peaked positive in January of this year. So we would be 6 months now. But if we don't count that and we say the next time it popped positive was, somewhere around here, which is, let's say it's March. So that means it'll be either the end of this quarter or so that will officially be in a recession, or maybe at the end of the year. We'll kind of see where it is. Anyways, all right. Consumer price index versus the personal savings rate. Let me see what time it is. We got 9 minutes. I don't know if I'm going to get done, but anyways, that is they're recovering, but basically we're back to our baseline. So basically the savings, the pre-COVID savings, is basically gone. The Federal Reserve is still tightening their balance sheet. They're still in tightening mode. They're way, way behind the curve. They are literally going to tighten right down into this economic slowdown. Oh well, it is what it is. All right. This is our M.2 money supply. So this basically shows, yet again, people's banks accounts are just dropping, and they're going negative, and they're getting smaller than what they were, a year ago. So yeah, all bad things. The consumer doesn't have the money anymore to weather another recession. But that's kind of what the Fed needs, right? The Fed needs a recession that the consumer doesn't have a bunch of money so that it can actually pull inflation down, get us back into normal situations and things like that. So unfortunately, that's the way the system works. So it's going to be kind of painful. Here's the tightenings of domestic banks. It hasn't changed yet because we haven't gotten a new reading or anything like that, but still very much squarely into recessionary time periods, right? Banks are tightening, so it's not a positive thing. Yet again, another recession indicator that we're basically going to start showing up. So the models are picking that up, and yet again, it should be happening. This quarter is when the GDP will start to come negative. So it might happen a month from now. It might happen tomorrow. It might happen over the next few weeks. But we should start seeing the reaction out of the assets that we're going into a recession. Recession/depression, 3 quarters of back-to-back GDP. It's technically a depression, but who knows? I mean, we didn't call the last 2 quarters of back-to-back GDP contraction in 2022 a recession. We called it nothing. So maybe they'll call depressions recessions now. Anyways, now, as far as our home stuff, we're going to talk about this more on the question and answer because this was actually something that got brought up to me. So we want to talk about it, but basically it's still very unaffordable at this point, but it is getting somewhat better. We'll see. Basically prices need to come down, or people need to make a whole lot more money, or interest rates need to come a lot further down. All of which are, interest rates will come down a little bit, so that'll kind of help out some things, but prices are still way, way, way too high for the everyday buyer. For someone that's going to live in it. That is not meaning that prices are too high for an investment property. That's a totally different animal. All right. bullishness is through the freaking Richter scale. I talked to you guys last time, and we were basically pushing into the all-time highs, and we did it again in the middle of the month, and we're just doing it more and more and more. I mean, just crazy, crazy amounts of bullishness. The bears have basically left the building. That's almost the smallest I've ever seen it, down here into the low 20s. Just crazy amounts of bullishness. You can see the bearishness was back there in September of last year, almost October, basically when the bottom of the market was. So if that's any kind of proxy, maybe we're close to the top of the market. All right, we got to do some more loans. We are up to 43 loans. Man, we've been pumping it out there, so it's been really nice and strong. And then we had an open questions. I have 6 minutes to crush through this guy. So, all right, the question was, all right, so the question was that why recently has the 10-year yield gone up? All right, so the why question. Let me first start off with the why question. Is kind of an interesting thing. It can sometimes make this a little bit of a hard question to answer, because looking backwards can sometimes be easier, right? I can come up with a reason. I can come up with quite a few reasons why this is happening. Of course, the more important question is will it continue, right? Will it continue to be this way? Are the same factors that's driving it up today, are they going to be prevalent over the next 6 months or whenever your time frame is for investing in a certain asset? So anyways, we'll talk about this right now. Okay. As inflation cools off, right, yields should come down, right? So why aren't they, right? Yields should kind of cool down. Well, remember, the longer part of the yield curve is separate from the Federal Reserve. But basically what ends up happening is as consumer spending ramps up, as acceleration in the economy ramps up, basically you start pricing in that the inflation is going to last a little bit longer and stronger than what you initially expected. So in general, the bond market prices in the rate of change of things. So are things getting better for the consumer? Are things getting better for inflation, or are they not? That is what it cares about. So as inflation accelerates, right? So as we were getting very accelerated inflation year over year, we got bond yields going up very high on the back end. As those expectations started to get to where, we're probably peaking out, right? As inflation peaked out, boom, the bond market started to level, right? As the peak inflation kind of hit and as it kind of rolled over. The longer that inflation stays high, the more the back end of the yield curve has to stay high or even lift high with it. So that's kind of the mechanics of the inflation. But with inflation coming down stronger, even though we've got some acceleration in the economy, we really shouldn't be having an acceleration over here. There's two things that could be happening. Either one, there's a little bit of over optimism as far as the amount of consumer spending that's going on right now, and that maybe we're not going to have as severe of a contraction as maybe what I'm projecting over the next 3 quarters. And I could just be wrong, and there you go. And then the bond market's doing its thing. There's also another thing that could be happening, is that there's not as much demand for U.S. debt as what previously was anticipated. So if we look back, this is a long time frame of basically U.S. 10-year yields, and as we've dropped yields more and more, basically holding U.S. government debt really wasn't a bad idea, because as they keep dropping interest rates, not only do you make the yield that they paid, but then you could always just sell them for a profit on face value at any given time as well. And it behooved you to buy in general US debt because inevitably the yields were just going to drop over time. Well, that was because we were coming off the back end of an inflation spike, right? Now that we're going into an inflation spike and we've had this inflation spike, there is, in general, there's a lot of US debt, right? Mainly everything, back to 2008, right? That is now underwater. Right now, I know we're talking about a 10-year, so you don't have it back here. But, if you're looking at the 20 years and stuff like that, you do have that issue. So if you look at a 10-year, right, going back to 2013, where we're at right now, all of these bonds are underwater, right? Everything that started out after that is underwater. Now, yes, you're getting your yield, but basically what happens at that point is you're taking on losses. And if you have a high inflation spike that's going to continue, and you've got a government that is on a spending spree, and they're going to continue spending, and they've lost control of their fiscal responsibilities, you don't necessarily want to buy their debt, right? This is what happened in Greece, right? With the Greece austerity crisis. You have a government that spending too much, right? You got pensions or whatever, whatever you're spending on. And they're not making as much as they're spending. And as they don't make as much as they're spending through either taxes or tariffs or whatever, however you're trying to make money, right? However your country makes money, then however the government makes money, then what ends up happening is you don't think they can pay back their debt. And then that country keeps on pumping it out more and more and more and more. And then all of a sudden, the world is satiated with that amount of debt. Then you add one more thing to it. All of a sudden, you get the idea or the concept that possibly the world reserve currency, which is the US reserve currency or the US dollar, that it's starting to lose its footing as the reserve currency. That could also be a problem because then banks' willingness to hold those currencies in the forms of bonds most of the time, they don't need to hold them as much because it's not as strong of a currency on the world stage anymore, and they need to start balancing it out with other currencies. And that can also decrease the demand for bonds. What I'm painting a picture here is a completely new paradigm of basically U.S. government debt being not so attractive. And we could actually end up going through something like a yield spike. Right? I doubt that we'll see something like that in a recession. Most of the time, you don't get it when it's in a recession because as a recession kicks in, there's more demand for bonds. So it's kind of a good thing for the U.S. to have a recession right now as the government is trying to finance its next, X amount of years with more spending, because then there's going to be actually demand for U.S. debt. But in the economic boom that happens after the recession, if they try to finance something through that type of thing, there might not be as much demand. So this is what can keep it can kind of keep a floor underneath the rates. We might not get the drop that we've gotten in previous recessions in the bond market, which is why I was saying gold might actually end up being a better asset for us to play during this recession than bonds. We will let the assets decide. We will let the models take care of that. That is most likely what's going to happen, though. So that's where we're at with that. The repo facility, by the way, the reverse repo facility has started to drain out. We already saw that a little bit. I just want to see if this is actually going to continue going or if this is just kind of like this general chop that we have up here. If the reverse repo market kind of starts draining out, that'll stabilize the front end of the yield curve, not necessarily the back end of the yield curve, though. So that really isn't going to affect the back end of the yield curve as much. So yes, we can put kind of like a floor and a ceiling around the front end of the yield curve, but not as much manipulation as on the back end of the yield curve. We've been doing it with mortgage-backed securities, but we'll see how that ends up working through this next recession. All right, this was the last thing, but I think I'm out of time. Yes, I am. So I'll talk about this more on the question and answer if you guys want to head over there. I'm going to go ahead and start that up. Or will it affect the market in the short term? Yeah. Yeah, Greg, I will handle the rest of that bond over on the Q&A just so that I can get that started, and I'll just pick it up from over there. All right, guys, have a great month, and I'll see you next month. And if you got any questions, in the medium term, go ahead and reach out to me, and I'll finish all of this on the question and answer, and then I'll talk about the home stuff as well. All right, guys, have a good one.